So our philosophy is really, really simple. Over time, what we've found in equity markets is that basically the market is a game of lots and lots of losers and very few key winners. So we looked at a study done by a guy called Henrik Bessenbinder. He wrote in the Journal of Financial Economics. And effectively what he did was analyse the buy and hold return of every stock on the US market over a period of 90 years. And he compared the buy and hold return to that of Treasury bills. It equated to roughly 25,000 companies. And what he found was that out of those 25,000 companies, almost all of them created no value versus Treasury bills over that period of 90 years. And actually the entire wealth generated by the US market over that time was created only by 1,092 companies. And so we plotted those 1,092 companies on the slide. And you can see their time in months on the x-axis and their annualized return, or their return on the y-axis. And you can see that all of those logos, and we've picked out several of those 1,092, but all of those logos benefited from some structural change in their industry. If you think about Boeing that opened up long distance aviation, if you think about McDonald's in quick service restaurants, or more recently, if you think about the big tech giants on the top left-hand side of that chart. So the top left-hand side of that chart is where we want to operate as your global growth investor. It's basically trying to work out what the next big wealth generator is for the market in the next period of 90 years, effectively. And so our investment philosophy is very, very simple. Firstly, we think earnings growth drives stock prices. That's a really simple statement. If a company makes more money every year, its share price should follow that money over time. Secondly, we think sustained earnings growth is worth more than cyclical earnings growth. So if there's a structural change, like one of those companies that I showed you on the previous page, then that earnings growth should be sustainable over a long period of time, and the market should probably pay a higher multiple for those earnings. And then lastly, we think the market often misprices growth and the sustainability of that growth. So what the market will often do is believe in mean reversion. So that means earnings are going up and then they're going to roll off, or earnings are going down and then they're going to bounce. As growth investors, we don't really subscribe to mean reversion. We believe that a company's earnings profile can grow in a structural or sustainable manner over a long period of time if that earnings profile is backed by a structural change in the industry. And so the best way to think about that philosophy is through the two charts on the bottom of the page. On the left, we've got MasterCard, which is their earnings in the dark blue line and the share price in the grey line. And on the right, we've got Bank of America in the same situation. And in both cases, it's the earnings that's driving those share prices over time. On the left, MasterCard's earnings is being driven by a structural change. That's a structural change that we all know and understand, which is the shift from physical to digital cash. But the market is incapable of pricing the sustainability of that structural change in. And so MasterCard's earnings have grown in a really sustainable manner over a long period of time. And the share price has followed that earnings growth. On the right, Bank of America's earnings is driven by all those macro factors, whether it's net interest margins or unemployment, or US CPI. Those are macro factors where we might have a view but not necessarily an edge. And so our focus in trying to find those few key winners is on the left-hand side, those MasterCard type situations where the earnings growth is sustainable over a long period of time and that the market often doesn't price in that sustainability of the growth.